Level 1. $100. It starts with a number that feels strangely small and impossibly large at the same time. $100 transferred into a brokerage account late at night, and suddenly the largest financial market on Earth is sitting inside a screen small enough to fit inside your hand. Trillions of dollars move through Forex every day, and now, technically, some of that movement includes you. The charts move constantly. Candles form, disappear, and reform again in seconds. Red, green, red again. And before the mind has time to analyze any of it, the body reacts first. A small spike of adrenaline, a tightening in the chest, a strange pull toward movement itself. The first trade is not placed because of strategy. It is placed because something on the screen feels convincing enough for a moment. A currency pair drifting upward, a buy button pressed with the confidence of someone who still has no idea how much they do not know. The trade closes in profit, small profit, barely enough to matter financially, but the emotional effect is immediate and wildly disproportionate to the amount earned. The market does not feel like numbers anymore. It feels alive. And that feeling settles deep into the nervous system far faster than logic ever could. Level 2. The demo account. The forums recommend practicing on a demo account first, so you open one. Virtual balance, real charts, real market conditions. And almost immediately, the account starts growing. Trades that would have felt terrifying with real money suddenly feel easy because there is no emotional consequence attached to losing. Positions are opened without hesitation. Risk becomes abstract. Losses become temporary inconveniences instead of emotional events. The demo account doubles, then triples, and the wrong lesson quietly forms in the background. The lesson feels like confidence, but it is really distance from consequence. Trading without emotional risk creates the illusion that decision-making is simple. It removes the one variable that changes everything once real money enters the screen: fear. The trader who leaves a profitable demo account carrying confidence into a live market is usually about to discover that understanding charts and controlling behavior are completely different skills. Level 3. Leverage. The broker offers 50-to-1 leverage. On a $100 account, that means controlling positions worth thousands. The numbers feel unreal at first. A small move in the market suddenly creates returns large enough to make ordinary jobs feel painfully slow by comparison. Gains that traditional investors might wait months for can appear in a single afternoon. And when leverage works for the first time, the market changes shape emotionally. It stops feeling distant and starts feeling immediate, fast, dangerous, full of possibility. The charts no longer look like information. They start to look like opportunity. What leverage hides behind the excitement is symmetry. The same mathematics capable of multiplying gains can erase an account just as quickly. A position turns negative, then more negative. The loss feels temporary at first, something that just needs patience. So the stop loss gets moved further away, then moved again. Closing the trade would make the loss real. Leaving it open preserves the possibility that the market might still reverse. It does not reverse. By evening, most of the account is gone, not from one catastrophic decision, but from a series of smaller emotional ones made under pressure. The margin call closes the trade automatically. The screen goes quiet. Level 4. The obsession. Another deposit is made. This time, the approach changes, though not in a healthy direction. The trader becomes consumed instead of disciplined. Charts stay open deep into the night. Economic calendars are checked before breakfast. Notifications interrupt conversations, meals, even sleep. The phone stays face up everywhere because price alerts now feel more important than silence. Forex has a particular ability to blur the boundaries between time and rest. The market never fully closes. London moves while New York sleeps. Tokyo opens while Europe winds down. Somewhere in the world, currencies are always moving, and eventually the mind starts moving with them. Every piece of news becomes connected to positions currently open. Interest rates, inflation reports, political speeches, employment data. Everything starts sounding like market information. The trader at this stage is no longer observing the market casually. The market has started occupying mental space permanently. Level 5. The blow-up. The second account survives longer than the first. It still ends the same way. One oversized trade, one position held too long, one stop loss ignored because accepting the loss still feels emotionally harder than risking something worse. The account balance eventually reaches zero. Not low, zero. And sitting in front of that number creates a kind of silence no tutorial ever prepares anyone for. Not panic, not anger, something heavier. The realization that the market was never really the problem. Most traders disappear here. They blame manipulation, bad luck, news volatility, the broker, anything except the behavior that placed them in that position to begin with. The traders who continue usually arrive at the same conclusion eventually. The position size was too large. The loss was allowed to grow because ego stayed in the trade longer than logic did. The market did not destroy the account alone. The behavior did. Level 6. Risk management. The next account opens smaller, and before a single trade is placed, a rule is written down. Never risk more than 1% on a single trade. After the emotional intensity of leverage and oversized positions, the rule feels painfully conservative. 1% of a small account barely feels worth the effort. But every aggressive alternative has already been tested, and every aggressive alternative already ended the same way. So the rule stays. Something changes when the maximum loss becomes small enough to survive emotionally. Trades close at stop loss without panic. Losses stop feeling personal. The need to recover immediately starts fading. For the first time, survival becomes more important than excitement. The account grows slowly, almost painfully slowly, but it survives. And eventually, that starts to matter more than speed. Level 7. Consistency. Months pass. The strategy becomes simpler instead of more complicated. Fewer currency pairs, fewer trades, specific sessions only. The trader who once stared at every chart across every time frame now ignores most of the market entirely. A journal appears beside the charts. Entries, exits, emotional state, mistakes, patterns. And over time, the journal reveals something uncomfortable. The losses are rarely random. They cluster around exhaustion, impatience, overconfidence after winning streaks, trading during emotional distraction, entering positions before major news releases simply because waiting felt unbearable. The journal becomes less about market analysis and more about behavioral analysis, a record of how human beings behave when money and uncertainty collide at the same time. Reading it honestly is difficult. Ignoring it becomes impossible. Level 8. The prop firm. The account is still relatively small, but the consistency is real now. A funded trading program offers an evaluation. Reach specific targets while respecting strict risk limits, and they provide access to larger capital. The challenge is passed quietly. Not because the trader suddenly became brilliant, but because discipline has finally become repeatable. The funded account arrives, $100,000. And strangely, it does not feel emotionally bigger than the earlier accounts did. The percentages remain the same. The process remains the same. The rules remain the same. Only the numbers changed. The trader who once reacted emotionally to every dollar now thinks almost entirely in probabilities and exposure. The emotional attachment to money itself starts fading. Level 9. Emotional detachment. After enough years in the market, a different emotional state begins to form. Not confidence. Confidence still depends on expectation. Not indifference either. The trader still cares deeply about execution, discipline, and risk. It feels more like neutrality. Trades are entered because conditions match predefined criteria. Outcomes are accepted because outcomes were never fully controllable to begin with. Winning trades no longer create euphoria. Losing trades no longer create panic. The process matters more than individual results. Over hundreds of sessions, the emotional meaning attached to red and green numbers slowly disappears. The colors remain on the screen, but the nervous system stops reacting to them the way it once did. The market finally starts looking mechanical instead of emotional. And that changes everything quietly. Level 10. 100 million. This level is not built through a lucky trade. It is built through years of survival, years of consistency, funded capital, scaled allocations, compounding performance, controlled risk, thousands of disciplined decisions repeated long enough for growth to become structural instead of emotional. At this level, the charts still look exactly the same as they did in the beginning. Candles continue forming every second. Economic releases still create volatility. Currency pairs still rise and fall without caring who profits from them. But the person watching the screen is completely different now. The beginner needed the market to validate them emotionally. Winning felt like intelligence. Losing felt like failure. That version slowly disappeared over time. Every blown account, every sleepless night, every painful lesson was simply part of the cost of reaching this point. And eventually, the market reveals what it always was beneath the excitement, fear, and obsession. Not a shortcut, not a dream machine, not a test of intelligence, just a system of probabilities moving without emotion. The traders who survive long enough to master it never really conquer the market. They conquer the emotional machinery inside themselves that once needed the market to behave a certain way in order to feel okay.